Hi, this is Stephen Carson coming at you from St. Louis, Missouri, in these United States. I was just talking about how I use that phrase on Twitter recently and why I use it. Anyway, really quick, excited to have someone back on the show. Hasn't been on a while, but first I'll just mention that we get gratefully receive support from folks at Subscribestar. Thanks to a couple new subscribers recently. Really appreciate it. And most people, some people are pretty generous, but most people just do $5 a month, price of a coffee, or cheaper than coffee. I don't know. I don't buy coffee. Price of a coffee or something a month. And it's a way to support the show, keep it going. And I have no problem asking people for that because I support the stuff I like. I support the stuff that I want to keep going. So if you like this, please head over to Subscribestar. It's in the video description on YouTube. If you're watching on Twitter, just go to my profile, and that points to my YouTube channel, and you can find your way there. Okay, let's bring on the guys. Let's see, which one do I want to use? Here we go. Welcome to Black Horse, sir.
How are you doing?
Very good. And we have Mad Mercenary in a triumphant return. Hello, sir.
Hello, how are you?
Very good. Now, Mad Merc has been basically having his life, and that has kept him from being able to join the show much in a while. But for those who are new to the show, Mad Merc started the show with me, and we did it together. I don't remember how long, Mad Merc, but it's over a year, maybe quite a bit over a year.
It's been about 2 years ago.
No. How long did we do it before you had to go?
Yeah, about a year. We did it about a year.
Yeah, so about the first year was basically me and Mad Merc with occasional guests. So original co-host, original one to get this all going. Get our annual art contest is something that he was instrumental in that we do at the end of the year. So anyway, great to have Mad Merc with us today. I'm going to get right to it. We have our usual Econ Minis where we're going to touch on a few things. And one of the things we like to do is occasionally check back in on certain stories. So we're going to start with one of those really quick. And that is German exports to Kyrgyzstan. Why do we care about German exports to Kyrgyzstan, Black Horse? This must sound like trivia, meaningless trivia.
Yeah, I mean, meaningless trivia, but look at that chart.
What does it mean? Now, wait, when does it spike up like that? What's the significance of that timing? That's like 2022.
Oh, it must be a major economic event in Kyrgyzstan. We all know that they've got a dynamic relationship with Germany.
Oh, absolutely. Sorry, new administration causing an absolute boom in their economy, obviously.
So it is. Sorry, just for those not necessarily looking at the screen, this is German exports to Kyrgyzstan, and we see a dramatic increase. It's 700% more.
Yeah, greater than 700% anyway.
Yeah, greater than 700% jump from somewhere in 2022 to June of this year. So what in the world does this mean, Black Horse? Is there a larger meaning here?
Yeah, so for those who have followed the show for a long time, we did an episode shortly after the beginning of the Ukraine war discussing the likely effect of the sanctions on Russia. And one of the key themes we hit at least 3 times in that episode was that in order to have effective sanctions on a country, you have to effectively blockade the imports and exports of that country.
Right.
Kyrgyzstan is they're part of the old Soviet bloc. They've got like a strong relationship with Russia. And what you're looking at here is indirect imports to Russia. So prior to the sanctions package being applied, lots of manufactured goods produced in Germany were purchased by Russian consumers. after the sanctions, lots of German manufactured goods continue to be purchased by Russian consumers.
Amazing.
With this very interesting Kyrgyzstani. I hope they make good markup on the way through, right?
Yeah, I was going to say some Kyrgyzstan middlemen are doing okay right now, right?
Yeah, one would hope anyway.
Unfortunately, that means you've got the Baptist Bootlegger Alliance type thing going on, right? You've got Kyrgyzstan middlemen who are going to agitate against the war ending or against the sanctions ending.
Correct.
Well,
Correct.
I'm not sure whether Kyrgyzstan has enough influence in the West to keep the sanctions going, but they'll do their best.
All right. Anyway, what we did not do is do a roundup of one suspects that it's not just Kyrgyzstan where you could find something like this if you hunted around. We did not do a roundup on all the various back doors that are allowing trade in and out of Russia to just continue despite the official sanctions. Mad Merc?
Well, yeah, this is classic, if you want to call it, quote unquote, sanction busting. Some people would just call this the natural forces of the market.
Right.
But if you can just have a look at the quality and condition of Russian supermarkets and Russian top end goods such as machinery or anything like that, they're still able to procure these items, and this is one of the ways in which they're able to do it. And now you have pretty much ostensibly Russian-owned companies going through Kyrgyzstan purchasing German goods, and they're decoupling themselves a little bit more from the West in this sort of sense. Yes, they still need the Western goods to go through a secondary source, but now they're also a little bit more independent and they don't have to go directly through Germany. So, this is an interesting turn of events.
Yeah, and just for clarity, to contrast this to like a historically effective sanctions regime, you would contrast this to like the trade restrictions around Germany during the First World War, where there was a very effective both naval and land blockade put in place that caused mass starvation in Germany during the period. So we predicted during that episode that there would not be a stable blockade of Russia for a variety of reasons. We're seeing in reality not a stable blockade of Russia. Both when we were talking about the natural gas market and when we're talking about the manufactured goods market going in the other direction. So,
right. So general pattern, if we were to try to prove this more, and I don't think we really need to, what the general pattern we see, right, Black Horse, is that Russia sells a lot of raw materials, lumber, oil, things like this, and raw resources, and purchases manufactured goods. This is a very common pattern, by the way. The United States was in exactly this position in the say early 19th century, selling cotton to the international market and other more sort of raw resources, and purchasing finished manufactured goods from England, for example, right? So it's just it's a certain stage of economic development that Russia's in, I guess.
Well, I mean, it's the permanent condition of the Canadian economy, where for
you guys
for
just
200
trees,
years,
just trees,
just trees, yes.
So if we were going to hunt around, what would we look for? We would look for the various ways that raw materials like oil and wood and so forth are making their way out of Russia, being purchased by India and things like that. And then the way that manufactured goods are finding their ways into Russia through the stands and China probably. I suppose China probably just continues to sell manufactured goods straight to Russia right across the border. I mean, I don't think that's complicated.
China's not part of the sanctions, so
right.
The only thing that complicates the Chinese export/import into Russia is just a geographic issue, and that's about it.
Well, there's
the
that, and
that
then there's any Chinese company that's there are all these many companies in the S&P 500 are operating in China, and because they're incorporated formally in the United States, they have obligations to enforce sanctions. So it's not like a total free for all, but it's it's not difficult for trade to proceed.
All right. Any other comments on this story? Okay, then let's talk about Steve Turley for just a moment. I forget the last count that my friend academic agent shared, but Turley was up to something like 17 videos he had made about the boycott of Bud Light, Anheuser-Busch over this Bud
In
Light
those
thing.
17 videos, at any stage, does he actually have his own thoughts on the matter? Or is it just reacting to an article or something that someone else has made?
I mean, maybe his own thoughts are that go woke, go broke is the iron law of the universe. What do I know?
Yeah, we haven't been reviewing the videos, but Turley is an indicator that I don't think it's just him, that a number of American conservatives, red state types, were mad about taking this working man's brand, Anheuser-Busch and Budweiser in particular, take this working man's brand and make it go woke with a trans representative, right, Dylan Mulvaney, and so they want to lash out. And it seems to me, I haven't watched Shirley's videos, but I gather from the thumbnails that he's selling that this has been marvelously effective. Black Horse is here to throw some cold water on that. So,
yeah.
Do you remember when the whole thing kicked off? Was it this year?
Yeah, it's this year. Right? You see that fluctuation in like May, June of 2023. So over on the right-hand side of that chart, there's a decline from about, I don't know, 67 to about 57 in the price of AB InBev. So there's like some reaction in the stock. But so when you say throw cold water, let's be specific about what we're talking about. So the American conservatives who have organized a boycott of Bud Light and some other related brands have been quite successful at reducing purchases of Bud Light beer in North America. Sales figures for Bud Light are substantially down, like upwards of 50%.
Wow.
However, AB InBev is a giant company with a portfolio of over 200 brands, many of which are brands that are common substitutions for Bud Light. So what you're looking at, so we looked at this in detail when we did our episode on this. Bud Light sales in North America represent like less than 5% of revenue for AB InBev, which is why you see very, very little reaction in the stock. So you're looking at a boycott that is dangerous to some like mid-level executives managing the regional marketing campaign for Bud Light. AB InBev might even lose, permanently damage that brand, and that would be unfortunate. But you're not looking at the kind of you're not looking at transforming the way that the company operates in any meaningful way.
I was just looking over all the brands that AB InBev has. Oh my goodness! Sorry, I just got to the American list. The global ones are, Budweiser, Bud Light, Busch, Corona, right?
Yep.
And I was going to try to pick out something specific to explain how, you'd feel like you're really being a rebel by, instead of buying Bud Light, buying some other beer that is AB InBev, which could very easily be done. It could very easily happen. In which case,
I mean, you could very easily switch to Corona and you'd be accomplishing nothing in terms of taking money out of their pockets.
Yeah. Move it from one column to another in their accounting, right?
Yeah, I mean, it'll give a tummy ache to some mid-level executive who might lose his job over the sales decline, but
right. Okay, and then furthermore, you wanted us to see the earnings because that would be another way.
Sometimes.
And I actually have a meta question really quick here, Black Horse, which is I sometimes feel like you can't take stock price too seriously. And I guess what I'm saying is I like it that you're bringing the earnings here, because it just seems like the stock price can there can be a lot of reasons the stock price moves, and maybe it's even the reason you're thinking, but 6 to 12 months later, that effect tends to like dissipate, and it doesn't necessarily really affect the bottom line of the company. You know what I mean? Is that a crazy view?
Sentiment is a huge element of stock pricing.
Yeah, I
and
guess
there
that's
are
what
a
I'm trying to
lot
say.
of other broad market elements. So, for example, changes in interest rate are a big element of stock pricing. Changes of interest rate have nothing to do with the company in particular.
Right.
So, when you're looking at the effect of something like a boycott, the stock price is, maybe a place to look, but if you get into the company's financial statements, you can really look at whether this has to do with something going on at the company in particular, or whether this is like a broad market phenomenon.
Right. Right.
And
so earnings seems a little bit less affected by sentiment, I guess.
Well, earnings
right?
are not affected by sentiment. They're actual numbers.
Well, no. What I mean is, okay, I see what you're saying. What I
Yeah.
mean is, okay, yeah. If sentiment turns into substantive action, like a truly effective boycott, you will see it in the earnings. Let's put it that way.
That's right. Earnings they're definitionally substantive. What actually happened, sales, money in and out of the company, gap revenue, gap costs, that kind of stuff. So what you're looking at here is earnings history for AB InBev, and the last two on those are consensus earnings projections. Typically, a company will issue earnings guidances that indicate what they expect the company to earn in the following several quarters. And so, you've got Q2, which includes some of the boycott. They beat expectations on earnings. That's what that green arrow means. Earn 72 cents a share of profits. So and moreover, they issued forward guidance for earnings that were, that were consistent with pre-boycott expectations. So you're looking at a boycott, which, although it has had a substantial effect on the sale of actual Bud Light beer, it has not had a substantial effect on AB InBev's financial position.
Right, which matches what AA was talking about back when there was that. I'm sorry, it was the Gillette ad, right?
Yeah,
that was very sort of demeaning to men, I think. And he was outraged and said, "I'm gonna boycott this company." Well, it turns out this company, in the case of Gillette, is a company called Procter and Gamble.
Yes, and Procter and Gamble makes everything.
Yeah, Procter and Gamble is every hygienic product under the sun.
And I think it particularly was bad when his child was born and he was trying to buy diapers and not buy them from P&G, and he found that it couldn't be done. Basically, nappies, right? Couldn't be done. Anyway, okay, so I really like how you took it, because you're like, well, that's could be seen as a discouraging story, but let's look on the bright side. There's another company that maybe some of us in the sense of what do you call it? We don't want to live in the pod. We don't want to eat the bugs, that kind of thing. In that sense, there's another company that we would like to see not do so well. And their story is a bit different, and that is Beyond Meat. I'm sure I'm not the only one who has seen Beyond Meat products sitting there on the shelves, fully stocked, no one grabbing them, as far as I can tell. This is something where we're starting with the stock price here, but the stock price is showing more than just sentiment. And I guess there's a couple things that we look for here, right? I'm just thinking about you as an analyst, Black Horse. You see a long-term trend as opposed to a little adjustment for a quarter or two. This is a couple years of downward.
This is actually the entire history of Beyond Meat's publicly traded stock price.
Right. But I'm talking about the downward trend starts in mid-2021. So we're over 2 years into a long-term decline in this thing. So this is a sustained downward trend. So this does not look like sentiment, right? When you see this.
So this is what it looks like to actually, for a company that actually can't sell their primary product. So there are two, when we talked about the AB InBev boycott at the time, I spoke to Oren McIntyre about this just privately, and I pointed out, like, the way to hit companies is to hit what are called pure plays. So Beyond Meat has one kind of product, and they sell it through one channel. And if you choose not to purchase that one kind of product through that one channel, you can do an enormous amount of damage to them.
Right.
Beyond Meat is one of these products. So like every grocery store that I go to here in Canada has like allocated shelf space for Beyond Meat for whatever reason. And I've never seen anyone purchase it. And you see,
my understanding with the way groceries work is that ultimately Beyond Meat is paying to sit there on that shelf.
That's right. That's why their bottom line looks so bad. So they pay for shelf space, and they've paid major restaurant chains to carry their products. So like McDonald's offers Beyond Meat products in some jurisdictions, various other elements. And you can see initially at the IPO, there's a big surge because Beyond Meat is like a huge darling of the ESG people. So it attracts enormous enthusiasm at the IPO. Stock rallies all the way past $200.
Right, and so, this would be we're always talking about BlackRock and so forth, right? This is where the BlackRocks of the world are like, oh yeah, we definitely want to buy that. This goes onto our ESG index and all that kind of stuff, right?
Yes, this looks like probably the biggest L that's been hung on ESG investors in the post 2020 era. So,
sorry, the magnitude of this is just hitting me. It shows it nearly reaching 225. I don't know what the dollars a share, I suppose.
Yes, yeah.
And now it's at 15.
Yes.
I mean, wow.
And not just like, it's not a small company. So the present, I should have pulled this, but anyways,
market cap.
The present market cap for this is 836 million, and that's with it stuck at $13 a share. So it would have been, roughly 30 billion at the time. So this is a $30 billion loss for the ESG investing crowd.
Wow.
Yeah, that is significant. No one is doubting that. But let's put this in perspective. This is one company in the ESG lineup, and the ESG lineup consists of many, many hundreds of companies. So I just want to put this in perspective for everyone who's maybe thinking, wow, this is a major win. Yeah, let's take the wins where we can, but also keep it in perspective. We have a long way to go.
Yeah. Yeah, no. Nobody should think that ESG investing is going away over the failure of Beyond Meat. But the point of contrasting these two, this is what a win looks like. AB InBev is not what a win looks like. And you can see this carried on. Maybe you think the sentiment's just bad on the stock. Let's go over to the earnings and the earnings projections.
Jeez.
Beyond Meat has its best quarter. The quarter it goes public, it earns 3 cents a share. And look at those losses.
Negative, losses ever since.
Yes, and not just losses ever since. Every forward guidance issued by the company, every analyst's guidance shows it perpetually losing money into the foreseeable future.
Oh yeah, right. That you show it out through end of next year, and they're still projecting losses through 2024
because of those all that money that they put out at supermarket chains, at fast food chains, in order to pay for shelf space, in order to pay to push the product. With no expectation of sales on the other side.
Yeah. Okay. So could someone say, well, yeah, but look at those green arrows. The losses are shrinking, or they've shrunk and they're projected to shrink more. So yay. How do you look at that as an investor, Black Horse?
This is a company this is a company that probably won't exist by the time we get to the end of this guidance piece.
Yeah, right.
It's going to be broken up and sold or something.
Right.
There's no. This is not a turnaround story.
You don't think there'll be an angel investor coming in to try and save the company?
Well, they may well get bought, right? That's what usually happens to companies of this size that get into this much financial trouble. Somebody somewhere decides that they can buys them out of bankruptcy court.
Yeah, and there's something to be salvaged, maybe for some other purpose or something, right? Out
Yeah,
of the company infrastructure or something like that.
Once they hit bankruptcy court, all those contracts that are causing these long-term losses will be gone. Because when you're in bankruptcy court, you have the ability to abrogate a lot of contracts that the company used to be associated with. So probably this will go to bankruptcy protection, and then the assets will get bought out of bankruptcy protection.
I just want to say free advice to the folks at Beyond Meat or someone who wants to come in and buy. I think they should pivot to spam. To me, that's just the obvious. They've got the infrastructure. They just need to sell spam as somehow like a cool thing or something.
There you go.
That'll do it.
Okay, well, let's stay on the woke capitalism thing and look at another effort. And it's a little unclear to me how much there is behind the desire to sort of punish woke capitalism. I mean, there's not zero. We see that with the Bud Light. I keep wanting to say embargo. Boycott. Yeah. The Bud Light boycott. I mean, there are certainly people out there, real consumers spending real money, who, if they can figure out how to do it, would like to redirect their money and hurt woke capitalism, right? So there is something out there, that's for sure. The question is, can it make itself felt in ways that really are make a difference, really, hurt enemies, right? And so here's another attempt. Target, I think, famously has been super woke. I don't know that I followed the stories that carefully, guys, but I seem to remember,
about the same time the Bud Light boycott came out, there's a parallel effort to boycott Target.
There we go. Yeah. Because they were really being super forward with the in their, you walk in their store and you couldn't miss it. It was my understanding.
Yeah, it was like the thing that really set it off there was all the quote tuck friendly undergarments, which is all like supporting. I don't even know how to clothing to begin social gender transition, but it's worse than that, because when you compress body parts at a young age, like it inhibits development. So
it permanently damages them.
Yeah. So it's not just like a kind of it's more than a social affirmation, but less than direct medical intervention.
I'm sure I'm not the first one to bring this up, but this is reminding me, I know it's not as extreme, but a little bit of like foot binding, the old foot binding practice.
Yeah,
right?
I think it's a good comparison. Like, these are essential body parts that you're, permanently compromising the function of.
Yeah.
I mean, maybe they don't think they're essential, but, I'm sorry.
Yeah. So some people noticed that Target was really pushing this stuff. They went the boycott route, but I don't think, unlike the Bud Light thing, which we could say did have a measurable effect, if maybe not the effect one would hope. I don't know that the Target. I haven't seen anything. I haven't seen Turley videos proclaiming the victories over Target.
Yeah, I mean, the Target boycott is interesting because, like, it's an excellent target for a boycott. It's a retailer. It's very visible publicly what is Target, what is not Target. So if you were able to motivate the consumer base of Target to boycott it, you could be very successful at that. Unfortunately, I'm not an expert in Target's marketing strategy, but I understand that, like, middle-aged women are the typical demographic for Target sales. And they're a little less enthusiastic than sort of working class beer consumers are about boycotting for these issues.
Mm-hmm.
So,
yeah.
so you saw some effect on sales at Target, but not nearly as dramatic an effect.
Right. So they're trying something else. And what is that? A lawfare approach, right?
Yeah. So a group of investors, Target is a widely held, publicly traded stock. A group of investors noticed that about the time the boycott of Target, the stock was down about $30, which is, I guess, about 15-20%. And they said, well, there's a case here that the actions of Target's management have compromised shareholder value, because you can look at the decline in the stock price, you can look at these public statements, and they line up really nicely. You have about as good a case as you're going to have for like a breach of fiduciary duty in these actions of management. So we talked about this a bit.
So technically, you could say, and tell me if I'm overstating it here, Black Horse, you could say that virtue signaling by the management of a publicly held firm, some would argue, is illegal. Or I'm sorry, virtue signaling that really hammers the bottom line. Maybe that's how I should put it.
Yeah. So from a technical point of view, the management of a company has a legal obligation to produce to maximize shareholder value, a legal and ethical obligation. And so if management takes actions that do not maximize shareholder value, you can make a legal claim against them for breach of fiduciary duty. We talked about this when we talked about the takeover effort at Twitter, that it was. And in that context, we noted that it would be virtually impossible for management to forever resist the takeover bid without some kind of alternate bidder, because they have because of these fiduciary lawsuits. So if they attempted to decline the offer and not deliver maximum value to shareholders, they would have been sued, and in fact, they were sued by Musk for breach of their fiduciary duty to their shareholders.
Right. In other words, you can't just say, I know this would be great for the shareholders, but I just really don't like Elon Musk. So the board of Twitter, are just not going to do it, even though it would benefit shareholders. You can't really do that.
Equally, if you can clearly show that the business strategy employed by Target's board in centering LGBTQ affirming merchandise is damaging damaging shareholder value, you may be able to extract either a settlement from Target or force the resignation of members of the board, replace the management, that kind of thing.
Right. But you're not super optimistic about this approach. Why?
Yeah, so fiduciary lawsuits are extremely difficult to win. So when we talked about this at the time of Elon Musk's takeover of Twitter, he was planning to pay $50 a share for a stock that was sitting at like $22 a share. It's very clear cut in court to say that turning down a per share offer that is like more than twice present price is a breach of your fiduciary duty. Very clear cut. In order to win a lawsuit like this, you're going to have to demonstrate that the decline in the share price of Target is permanent and a direct consequence of this business strategy choice. That sounds very hard to me. Nobody knows why stocks go up and down most of the time. There's a million other reasons why you could say that the price has gone down. And you could also argue that management is working this is the argument that's always used in defense. It's actually in the long-term interests of the of the shareholders rather than the short-term interests of the shareholders. So yeah, maybe the price of the stock went down immediately after we made this choice, but 6 years from now, it's going to turn out to be the right thing for the business. And the benefit of making this argument in court is that it's impossible to disprove.
Right.
So this is going to be a very uphill battle in order to attempt to extract a settlement.
All right. Let's get to our main story then. Black Horse is going to shockingly praise the Biden administration. Something like that. Is that what's coming?
I guess so. I mean, we're all watching the victory laps in the broad media about victory over inflation. And in this case, they're actually accurately stating in effect. So we're looking at here a chart of producer price index. Producer price index tends to be the leading indicator of inflation. Red here is all goods. Blue is goods less food and energy. So you can see they're getting some benefit from the decline in food and energy prices. But even if you exclude the commodity price benefit, broadly, the actions that have been taken over the last couple of years, or I don't know, maybe it's 15, 16 months, have reduced price inflation in the United States.
And just real quick to make sure everyone's following along, why are we looking at PPI instead of CPI, Consumer Price Index? Black Horse explained it because Producer Price Index is leading. So that is, if you want to kind of peek ahead at the future of what's going to hit regular folks in the pocketbook, affect our what we face, take a look at the PPI. That's going to tell you, I don't know, what's the lag? 6 months or something, it seems like.
usually 2 or 3 months.
Oh, or even less. Okay, just yeah. So look at the PPI, and that tells you what the CPI is going to look like a couple months from now, right? Generally.
Yeah, and there's some questions in the chat about whether the definition has changed. The definition of PPI has not changed in the period in question.
Okay, yeah.
So
it's apples and apples over the last couple of years here.
Yeah.
So inflation is. Price inflation looks like it's coming down. We're actually having, I guess, price deflation, lowering prices. And how have they pulled off this miracle, Black Horse?
Well, let's have a look. This is our main story for today. So let's have a look at the Mises Institute article here, and I think this will come into focus a bit.
Just dropping that story into the chat if you want to see for yourself. Okay, so Ryan McMacken, my friend over at Mises.org, money supply has shrunk for 8 months in a row. And he does a lot of historical comparisons that are interesting here. Money supply growth fell again in June, remaining deep in negative territory. Okay, so let me unpack that. Negative money supply growth is a double negative way of saying the money supply is shrinking. Okay, so he's saying it fell again, meaning it's shrinking, and it's shrinking even more in June, right? And so when did this start happening, that we started seeing money supply shrinking? November 2022. So that's based on the recent stats we've got, which, it takes a while to get these stats, right? So we're almost a month and a half from this. But 8 months from November through June, we see the money supply shrinking throughout those 8 months. If the trend continues, then we're on month like 10 of this, right? But we'll have to get some numbers later to see about that. Okay, so it's been negative for 8 months. What is that in absolute figures? Year-over-year growth in the money supply was at negative 12.4%. This is actually, as I understand it, we'll see a good comparison here in a moment. It's actually kind of significant. It's not like a negative 0.5% or something. It actually is something that you start to see real-world effects with that kind of money supply shrinkage. To give an indication, he compares to the Great Depression, which a lot of people put emphasis on the fact that the money supply shrunk during that time. Milton Friedman famously said, they just needed to not do that, and then everything would have been fine. Austrians disagree, but anyway. So with negative growth now falling near or below negative 10% for the third month in a row, money supply contraction is the largest we've seen since the Great Depression. And I think we're going to see some numbers. Oh, yeah, there we go. Yeah, I think we'll see numbers in a moment. So at no other point for at least 60 years has the money supply fallen by more than 6% in any month. And here we see the year-over-year change. The red line is 0. This chart only goes back to 1988. So we see occasional money supply shrinkage in 1989, 1995, things like that. But other than that, we haven't seen anything.
Notably, the last time we saw any at all was 1985.
Yeah.
Wait. I'm sorry. You're talking about from the point of view of the M2, right?
Yeah. So
yeah. This chart is showing this other measure that the Austrian school uses. But anyway, yeah. By whichever measure you use, it's been decades since we've seen the money supply shrink. So what is this? Why does this matter to us, normal people? Because during periods of economic boom, money supply tends to grow as commercial banks make more loans. We'll return to that loan issue in a minute. Recessions, on the other hand, tend to be preceded by slowing rates of money supply growth. So that is, again, a leading indicator of what we might be facing in the general economy. Mises points out that recessions are often preceded by a mere slowing in money supply growth. But what we've seen, right, is that money supply has shrunk. That is, it isn't just, this happens all the time with dealing with Washington, D.C., right, and other governments, I'm sure. We're fighting growth in spending, and what they mean is we were planning to grow the spending by 12%, and instead we're growing it by 11%. Yeah. And that's like this great victory, right? And Mises says, well, in fact, you can have a recession preceded simply by growing the money supply significantly slower than it had been growing. That can be enough. But we're way beyond that right now. We're at actual money supply shrinkage, sustained money supply shrinkage. And that is generally a red flag for economic growth and employment. And why is it so striking? Because the money supply almost never gets smaller. It has now fallen by 2.8 trillion, or 15%, since the money supply peak in April 2022. So that's not that long ago. So a year and a half ago, it was significantly higher, and it's 15% down from that. It's the largest fall we've seen since the Depression. Rothbard's estimate, and economic historians can disagree here, but Rothbard's estimate is that in the lead up to the Great Depression, the money supply fell by 12%. We've seen a 15% fall. So if you think the money supply falling could portend some rough times in the economy, this is serious. This is a serious money supply shrinkage, right?
Yeah. So a couple of things to note here. This chart actually does a really good job of capturing it. We see money supply shrinkage here, but it's money supply shrinkage after massive money supply growth. So
right. Yeah,
we're in a kind of weird situation where if you look at that chart, after money supply shrinkage, we're kind of we're getting back towards the long-term trend line here.
It's not even to the long-term trend line. It could shrink quite a bit more before hitting the long-term trend.
Yeah, perhaps. And so it's I don't want to you saw this with a lot of statistics after the event of 2020, where you had this massive oscillation. Like you had a move in one direction, then a big overcorrection in the other direction, and eventually a return to normal. So we need to be cautious here and not sort of overselling what's going on, comparing it to the Great Depression. But whatever whatever you want to say, this is a very significant change in the management of the U.S. economy.
Right. And this is tied, I guess, for us normal folks, Black Horse, this would be tied to higher interest rates. Right?
Yeah, well, that's what we'll
reduces
get at
loans.
here. That's what we'll get to here in the next section. But interest rates are one element of what's going on here. But there's been a broad set of factors that have led to this tightening.
Yeah, just wanted to highlight a couple things that Ryan in this article points out that are correlated. The Philadelphia Fed's manufacturing index is in recession territory. Empire State Manufacturing Survey is also. Leading indicators index keeps looking worse. The yield curve points to recession. We've discussed that before, the inverted yield curve, which has been inverted for quite a while now.
Yeah.
Right, Black Horse. And then individual bankruptcy filings up 68% in the first half of 2023. Temp jobs down year over year, which often indicates approaching recession. So recession. So we're seeing a number of things line up that point in the same direction, right?
Now, if I could jump in here,
yeah,
there could be people in the chat and others who would say, well, we have all these indicators. We have the yield curve. We have we have all these indicators that are suggesting that we're headed for a recession, or that some people believe we are in a recession right now. People could be asking themselves, well, why hasn't what is going to be the straw that breaks the camel back, and why hasn't the camel broken yet? Well, what do you gentlemen think? Because it's been this way for at least 2 years now, that this sort of extreme economic policy has been taking place due to COVID and due to mismanagement at the Fed. Is there a point at which people just start to say, well, all these signs, they're not really leading to a recession yet, so maybe they're no longer valid?
Mm-hmm.
Yeah, I think we'll get to this as we go through some of the other data points here, but it's worth noting that if you follow the kind of Twitter economist group, there are a number of people there who have called dramatic economic contraction over the last year and a half, and that dramatic economic contraction has not yet occurred. So it's worth putting that out there as we go through this.
Okay. Just a reminder, I've got a good comment, someone fighting back on the InBev story earlier. We'll try to hit that at the end. But anyway,
yeah.
Okay, right. So money supply shrinking, rising interest rates, right? Soaring credit card debt, even as interest rates soar. Because why is that interesting? Because credit card rates are usually not fixed; they're usually variable, if I remember correctly.
Yeah, credit card rates are typically variable. They're typically much higher than prime interest rates. Credit card debt levels typically indicate the health of the low-end consumer. So if you've got high levels of credit card debt, what you're looking at there is like a low to low middle income consumer that's not doing very well. So same thing with personal bankruptcies. Again, you're looking at that target consumer demographic we were just talking about for Bud Light. They're not doing well.
Right. And then this one hits us here at the Rad Lib household, because we need more cars. Both new and used cars are becoming increasingly unaffordable. And what was that figure you said? It's the car prices, or used car prices, have gone up 25%. Was it used car prices?
It's like 23% a year for 3 straight years.
Whew.
Something like that.
Wow. That is beating inflation, fair to say.
Just a little bit.
Yeah. Okay, so I think that's what we wanted to get from this article. I shared that to the live chat. let's look at a couple things to give us parameters on this. So first of all, the federal funds rate.
Yeah. So what first question is what's causing the decline in the money supply? The Fed funds rate is kind of the first thing to look at. So increasing reference interest rates will draw money out of the economy, both because it will attract people to buy government bonds, but also buy government bonds, deposit money in banks, that kind of thing.
Mhm.
But also because as it increases, there's a whole pile of other things that are pegged to, like floating interest rates that are pegged to the federal funds rate. So when the federal funds rate goes up, interest payments on everything from credit card debt to corporate bonds go up, which takes money from people likely to spend it and puts it into these kind of immobile. It reduces what's called the velocity of money and decreases the effective money supply.
Gotcha. Yeah, and it's interesting. This chart goes back to 1955, so it gives an interesting perspective. Namely, this Fed funds rate is not historically dramatically high. We've seen it way higher throughout the 70s, 80s, right? Way
And
higher than it is right
I
now.
wanted to give the long chart because I wanted to highlight the fact that increases of this magnitude and velocity in interest rates are not historically unprecedented.
They do seem to precede those those long gray bars, though, don't they?
Yes, those gray bars are recessions, so
Right.
they're quite commonly associated leading indicators of depression
Yeah, and
recession.
and I'm going to lose track of which. It was this year that we did the story on the
The
non-recession.
non-recession, yes.
Yeah. So according to traditional standards, which they just redefined on the fly this year, 2 quarters of negative growth meant that you were in a recession. So if you use that old metric, was it Q1 and Q2?
Yeah. So
Yeah.
the two latest quarters here on the far right should also be gray by that metric.
Right. So they're just they just redefined, did an Orwellian redefinition of recession.
Yes.
But that would show us in, well into probably Q3 of a recession. They're just not calling it a recession. But that would mean that it would line up with this pattern we see, which is where you see the Fed funds rate jump, and then you see a gray bar of recession after that, right? Including that 2007, 2008 period that we've discussed, did a whole series on this show. I'm sorry, Mad Merc, were you trying to get a comment in?
No.
Okay.
But
okay, then
one of the things that I want to highlight here as quite unusual is that the liquidity suck here is not just interest rates increasing. So if we go to our next slide here, where we also have for the first time, well, maybe for the second time in modern history, the Federal Reserve is actually decreasing its balance sheet. So for those of you who followed the show, you'd be well aware that ever since 2008, the Federal Reserve has at various times bought large dollar values of assets, a combination of government bonds, mortgage-backed securities, various different things, in order to, the effect of that, they call it quantitative easing. The effect of that is to increase the money supply. When the Federal Reserve sells those bonds back into the market, as they have been doing for the last 8 months, it effectively contracts the money supply using a different mechanism than their standard interest rate mechanism. You'll see on the right-hand side there's that brief upward movement. That's the bailout of the regional banks during the SVB situation earlier in the year.
Mm-hmm.
But apart from that bailout, we're looking at a pretty consistent pattern of divesting themselves of assets. Obviously they've got a long way to go back to 2008 levels of assets.
Yeah.
But I wanted to point out both the like compared to the asset at volume they have, it's a fairly small divestment. Compared to interest rate changes in the past, it's certainly not a historically unprecedented interest rate change.
Mm-hmm.
And yet the effects that we are seeing in the regular economy as a consequence of it are extremely dramatic by historical standards. And probably the most profound of these effects is in the housing market. So the next slide you've got here is standard mortgage rates.
Mm-hmm.
So as we discussed earlier, mortgage rates tend to be pegged to reference interest rates. So the mortgage rate chart here should look basically the same as the Fed interest rate chart, and we can see that it mostly does. There's some weird stuff going on in the period between 2010 and 2012, and the period between early 2013 and the end of 2013. But that's a subject for a whole other show. Point being here, you see this dramatic increase in mortgage rates, and you see, if we go to the next slide, a corresponding reaction in housing prices. So again, we've got a big, long chart to give us lots of historical context on housing prices. Again, St. Louis Fed data. This is average housing prices across the United States. So you're going to see different effects in different regions. But you see, we have 2 quarters of data since housing prices started going down. And in those 2 quarters, those housing prices have gone down 14%, which is the largest decline in 2 quarters in the entire history of this chart. So this chart goes back to 1964, I think.
Yeah.
It's not declared. It's notably the reduction in housing prices are usually corresponding with those gray lines, which are recessions. So
yes, which we would also be in if we had this.
Yeah, if they didn't change the definition on us. Oh, this is the time for Mad Merc to say goodbye for the week, right?
Correct. I do have to go.
Thanks for joining us, and hope to have you on more often.
All right, I'll see you all next week. Goodbye, everyone.
Bye. Yeah. So, what did you say? 17% in 2 quarters.
14% in 2 quarters.
14%, and what my general sense, and I'm sure you're seeing some indicators that I wouldn't have access to. Well, I probably do have access to. I just don't know how to use them. But anyway, my general sense of everything we've looked at so far is that the trends we're talking about this year are continuing to the current day. We have no reason to believe that the Fed funds rate is not down. We know that. Mortgage rate is not down. Housing prices are probably continuing to go down, right?
Yep.
So all these trends are continuing to the current moment, and we don't have any particular reason to believe.
Well, and the last time we had like anywhere near this magnitude of retracement in housing prices, we had the credit crisis of 2008.
I know, which doesn't look so bad compared to what's happening the last 2 quarters, does it?
Yeah, no,
it's a big drop, but it's over more time. It's over a couple of years.
Yeah, so the total decline in housing prices in 2008 is larger than the decline we've seen so far, but it occurred over a period of, I think, like 6 quarters, 7 quarters.
Mm-hmm. Right.
So it's unclear. We don't quite have enough data to be able to compare apples to apples with the 2008 moment in terms of housing price decline. But we're talking about a pretty dramatic story here. Now, it should be said that, like the decline in money supply, we're looking at a decline in housing prices after a pretty dramatic escalation. So whether we see what you would talk about in a stock chart support at the old trend line, I don't know. But it's these are very profound contradictions to very profound. So typically when asset prices fall, when you've got bad indications in the broad economy, you would see the Fed attempt to be accommodative. So you've got these really strong contradictions going on at the Fed right now, and it will be very interesting to see which trend they choose to break. So they've, to this point, they've taken aggressive action in order to reduce the money supply and curb inflation. It will be interesting to see whether they simply accept the consequences of that in the broad economy, or whether they react to the consequences of that in the broad economy and reduce interest rates again. But we continue to be at this crossroads of with the question of what they're going to do.
So I just want to bring in the political part of political economy here for a moment, because I can't help but notice that in the 2008, 2007, 2008 period there, it was George W. Bush was the president.
Yeah.
Okay. And so as I recall, the media was happy to announce that we were having a housing bust and make a big deal about how terrible it all was. I'm kind of wondering if, this decline continues in housing prices, becomes of even greater magnitude quicker than what we saw in 2007, 2008, whether the press would call it a housing bust. If you follow what I'm saying.
I mean, if you just scan the headlines of the mainstream press at the moment, you would not know that any of this is happening. None of the indicators that are in McMeekin's article appear in the mainstream press. I've seen a little bit about the decline in housing prices, but certainly nothing like the sob stories about foreclosures that we saw after 08. Right. Endless sob stories.
And I assume anyway, would there be foreclosures right now?
Yeah, there are foreclosures. Foreclosure rates are at the highest level they've been since 08. So,
okay. Not higher than, but moving in that direction.
Moving in that direction, and foreclosure data tends to be, again, backward facing, so it's not clear how this moment stacks up, but certainly we're not looking at, especially because the stock market hasn't been severely negatively affected at this point. We don't have the same kind of histrionics going on. So it'd be very interesting to see what happens here.
Unless Trump gets reelected, we're not going to get any bad news, even if there's bad news to share.
Well, I don't know. I don't know how. It seems to me that the media is less in love with Biden than they once were. So maybe
that's true.
Maybe they'll want to throw him overboard or something. But
right. And say, oh, look how rough the economy is suddenly, right?
Yeah, I guess. Especially if they manage to get somebody else running instead of Trump, maybe you'll see lots of news. But
right. Someone they're not as scared of becoming president.
Yeah, I mean,
so just to toot our own horn, I would say that if you want to have a realistic assessment of what's going on, you're probably better off watching our show, frankly, than the mainstream headlines, because they're just not going to tell you some of this stuff, because they don't, for the moment at least, they don't want to make the administration look bad.
Yeah, I mean, at the moment, mainstream media is extremely influenced by political objectives, and so
right. Okay, so anything else on this? Because I wanted to return to one other topic before I let you go.
Yeah, no, I just want to emphasize the size of this contradiction. So the decrease in the Fed balance sheet, the interest rate increase, these are not historically unprecedented changes, whereas the change in housing prices is, which suggests to me that housing prices are now more sensitive to interest rates than they have been at any point in the past.
Yeah, what is that? Why would that be? I don't. I guess it could be. I mean, it is a pretty steep hill that this house price goes up before it starts dropping. So maybe it's just kind of in a bubble, and so the sensitivity is that it's letting the air out of the bubble or something, right?
Yeah, that's possible. The other piece is that Like if you look at the long history of house buying in the U.S., the level of leverage involved in house buying has increased substantially since the beginning of this chart. So, like if you were a first-time home buyer in 1975, you probably borrowed a much smaller percentage as of the property's value.
Yeah, the amount that you put down or whatever has, as a percentage, has decreased over time, right?
Yes, and so we're typically down payments are a little bit higher than they were pre-08, but also the average age of a mortgage right now is less than it was in 08, primarily because properties are broadly turning over in the United States. So the average age, of a mortgage is a little bit less, which means the average amount of leverage in a mortgage is a little bit higher. So,
okay, gotcha. Meaning it makes the whole system more sensitive to changes in the interest rate, right?
Yeah, a little bit. So, given the given those factors, it's not entirely surprising. But what you're looking at here is a microcosm of an economy that I think broadly should be extremely sensitive to debt because of the high levels of debt that are in it. Whether that's high levels of credit card debt or whether that's high levels of commercial debt. So one of the major trends in the period after 08 was the substantial increase in debt on corporate balance sheets. So that makes like S&P 500 earnings much more sensitive to interest rates over time. Everybody knows about the increase in federal debt over the period in question, which means that already the interest on federal debt is up to number 3 on the list of expenditures, behind military spending and entitlements. So we're looking at an economy that should be extremely sensitive to these changes, to this kind of tightening. So even what would have historically been a pretty normal cycle of credit tightening might have an outsized effect on the sort of lived reality of the economy.
Okay. Oh, wait a second. I was going to share something, but it's been deleted. Can I pull it up? Okay. He thought better of it. Okay. Well, that's all right. I can go with this. So someone was not happy with our InBev coverage.
Okay.
He said, I usually love your shows, but your guests this week have no idea what they're talking about. Okay. Now he deleted the tweet, so he took it back. But what he pointed to was a zero hedge story from today. No end to the destruction at Anheuser-Busch. I somehow have not seen that. Anheuser-Busch. Yeah. Very nice. Okay. Bud Light weekly volumes were down negative 29%. Continues to be contagion to the wider AB InBev portfolio, with Budweiser, Busch, and Michelob still weak.
Yep.
Okay, so he's seeing red across more than just Bud Light.
Yeah, the primary victim here is Budweiser because it shares the branding is pretty similar.
Yep.
So volumes are a couple of things here. We went over this in extraordinary detail when the Bud Light boycott hits. You can go back and watch that episode. But domestic beer is something like something like 20% of the revenue of AB InBev is beer sold in the United States. Gotcha. And then multiply through, even if you see damage across a couple of the major brands, Bud and Bud Light being the two that are most severely impacted, you're not seeing it's not enough to move the earnings needle for AB InBev, which is why you saw all the information you saw kind of earlier in the piece. The other thing is to realize that there's two other really significant segments to AB InBev. There's international, which is bigger than domestic. And then there's non-alcoholic beverages.
Yeah, I was going to say, they probably sell like bottled water and all kinds of things, right?
60% of the revenue for AB InBev is non-alcoholic beverages, brands that have no popular association at all with Bud Light.
Right.
So I pointed out at the beginning, there's something like 200 of these various different brands. So if you go back and watch that show, you can see we pulled a list of them on air, I think. So that's the answer to that particular story. I am not arguing, to be clear, that sales of Budweiser, Bud Light haven't declined. They obviously have declined.
Yeah. Definitely. Right.
The point,
and we did, to be fair, we did not highlight that it was, Busch, Michelob, Stella Artois, Natural. I mean, I didn't know all these things were being affected. It's kind of I have to say, I'm kind of impressed that they were smart enough to hit more of.
I mean,
don't even sound the same.
Hitting Budweiser was fairly obvious, but it's impressive that some of these other brands have been affected.
Yeah. So good on the efforts there on the.
For congratulations, Middle American consumer, you've done pretty well at your boycotting effort.
Yep.
And you've correctly identified that Coors is a separate company. Fine.
Oh, okay. Yeah. By contrast, they're showing Coors and Miller Lite and so forth, and they're doing.
Yeah, fine. Coors and Miller are that's the big competitor in the domestic beer market, and so obviously some consumers have switched.
Yeah, so they have succeeded in shifting out of the AB InBev portfolio for their beer drinking and shifted to similar products from somebody else that isn't AB InBev. So pretty smart, pretty impressive.
Good on them for the boycott.
Yeah.
And that's why you have a cadre of middle managers at Bud Light. Some of them have already been fired. There's going to be a group of middle managers there that are going to have some heartburn and maybe lose their jobs.
Right.
That's very different than existentially threatening AB InBev as a company is the point that we're getting at.
Yeah, and I hope to be clear. I'm not being at all sarcastic. I am impressed by the organization. Organization ultimately wins. So this level of organization pointed at like you said, at a more vulnerable target could have done real damage for sure.
Yeah, I mean, if you had been able to organize a comparable consumer effort at Target, Target would be like the company would probably be in different ownership by now.
Right. Yeah. Right. Yeah. So this level of organization is impressive. It just needs a little bit of guidance from elites who know how to direct it prudently, right?
Yeah. Or, I mean, on the one hand, Budweiser is an excellent target because its consumer demographic is the consumer demographic that the Matt Walshes of the world have a great deal of influence with.
Exactly.
Which I think is why the boycott has been as effective as it has been.
Mm-hmm.
Unfortunately, it's held in this giant conglomerate that is very, very difficult to shift.
Right.
So.
Okay. Anyway, so even though he deleted the tweet, I appreciated the pointer to the zero hedge story. I thought that was useful. Okay. I think we are going to stop for now. Okay. I have a question, but I won't ask it on air. Let's see. I just want to make sure I'm not missing any tips or super chats that have come in. Oh, wait. Was that one? August 3rd. Oh, no, that was last week. I got it right. Yes, I got that one last time. And yeah, we're good. We're good. Okay. I think we're good for this week. Thanks once again, Black Horse. So glad we had Mad Mercenary able to join us from his, he's like, sort of Black Horse and I are a little older. So Mad Merc is sort of starting his life, right? And
yeah, he's
our sort of in the midst of it.
our connection to the Zoomer generation. Put it that way.
Right. But anyway, thank you very much. We will, obviously, this is going to be a very interesting story. And I guess there's two things I'm interested to keep an eye on Black Horse over the next half a year or more. One is, do we see more and more indicators of like a deepening recession? And number two is, how does the media spin it? Do they basically continue to try to, no matter what happens in terms of all the solid economic indicators that we look at on the show, do they just continue to act like everything's hunky-dory, right? Those two sort of paired stories, I think, is something for us to dip back into over the next half year now and again.
Yeah, and not just how does the media react. I mean, the thesis that so there's a controversy in our circles over to what extent the regime that governs the West is fragile. And if we see like a genuine economic crisis emerge, we may get a test of that thesis that we can kind of evaluate. So,
Right.
We'll keep an eye on it.
Yeah, and how far does it work to say, la la la, I can't hear you. I can't hear you. Recession.
Yeah, exactly.
We just pretend it's not there. It'll go away. Does that work for them? It could, at least for a while, right?
I mean, it's working so far.
Yeah, right.
So.
I'll let us go. But last thought on that is just that our perception of what's going on more widely is ultimately, let's be fair, influenced by the media, right? Because we know what's going on with us. Maybe we know what's going on with our neighbors and maybe even our community at best. But we don't really know if like the nation is in recession.
Yeah.
From our common everyday experiences, right? There's certain people, well-placed people like you, who maybe would have a view of that sort of thing. But most of the public that would be inclined to get grumpy with the administration, they know what they're told about the broader trends, right? And what you just pointed out is that they're not highlighting a lot of the trends we talked about on the show.
I mean, in order for regular people to be aware of an economic crisis, it has to be way more severe. Like even 08, if you like didn't own a television and didn't read a newspaper report, you might be a little bit aware of 08, but not the way you would have.
It was not the Great Depression, even then.
That's right. It wasn't even close.
Yeah.
So we'll see what the scale of this event is and go from there.
Yeah. All right. Well, thanks very much. Bill Wilson says, I work in manufacturing. Sales are down. All right. Yeah. We'll keep an eye on it. Okay. Thanks to Black Horse. Thanks to everyone for joining us. Thank you for your support of the show at Subscribestar in the video description. And we're done for today. Talk to you next week.